Hey guys,
Good morning.
Good morning.
happy Prime Day.
Yeah, it's the big day, the
Cool.
big week.
Yeah, it would be
It's an
interesting.
amazing thing, capitalism, isn't it?
It really is. Prime Day always on a prime numbered day? That's my question. I because today's the 13th and 13 is prime, but
Tomorrow's the 14th and 14 is not. So
yeah. Well, is it tomorrow or is it today?
yeah, today and tomorrow.
Okay. Well then, there goes. Because if you want consecutive primes, it would have to be on the second and the third. Because I think that those are the only two consecutive primes.
Yeah, otherwise you'd be what, the 13th and the 17th?
Yeah.
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 Yep. Well, just 73 days to go to Christmas. It's certainly
I know.
Holiday season has started early. Sure.
Well, you can tell I was at the store this weekend and the first Christmas beers were on the end cap, and I shudder. It's not even Halloween yet.
I know. You got to leave holidays time to breathe.
Right.
I can't commingle my spices. I need my pumpkin spice separate from my Christmas spice. You know?
It's cinnamon. So pumpkin spice is nutmeg, basically, right? So
I think there's some cinnamon in there, there's some ginger.
Yeah. So
I like
Christmas spice. What's the difference? I feel like it's a lot of the same flavors. It does.
A lot of
taste
Christmas beers have like orange peel in them, a lot more ginger, some cinnamon stick. I like spruce tip. I don't know if you ever had like spruce tip
I can't
tea
say
or
I'll
spruce
have to
tip
try
in beer.
I'll have to try that. I do like spruce, the smell of spruce.
Yeah, I'm planning a sour cranberry saison for this Christmas. So it should be something interesting, or it'll be terrible.
You know, either way, you learn something.
Yeah.
Guys, did you see the story today in JSC about global parcel volumes are expected to double in the next 5 years? Kind of a staggering statistic.
I wonder how much you'll see if passenger air travel continues to lag, how much you'll see the conversions ramp up of commercial airliners to freighters.
Right.
I mean, Delta was it Delta this morning? I mean, just an abysmal number.
Yeah.
There's no bueno.
I mean, the article was fascinating. It mentioned FedEx, Ken, where it said that US to market, they projected it would hit 100 million packages per day by 2026. They think that'll happen 3 years earlier now. We'll hit that target by 2023.
Imagine if there's a coronavirus vaccine, you need 300 million of them.
Right.
I mean, I know Warp Speed's going to be a lot of government, but I have to imagine they're going to lean heavy on FedEx and UPS's airlift capabilities to move that stuff as well. Yeah, I mean, no less than a year ago, they were struggling for international air volume, struggling mightily.
Exactly. Down in the double digits range year over year.
Yeah, so. And
we've broken more records with the hurricane season again.
Yes, potentially Epsilon. All right, I'm in my basement this week because we switched to virtual learning impromptu, so I apologize. My producer was telling me action, and now I'm going to listen to her. So I want to welcome everyone to our live broadcast. If for those unfamiliar, every week we gather Ned, who's our principal data scientist, and Dean, who's our principal industry analyst. We spend about a half an hour or so once a week talking about what's going on in the market, interesting trends we're seeing, what the data is telling us, and then pretty much all the stuff we learn from talking with our customers and other folks in the industry. So we're here each week. If you appreciate our content and want to see more, like and subscribe. It's the easiest way to be notified when we're here. And we ask that if you have any questions on any of the platforms this is streaming on, to please get those typed up, and we will do our best to answer them at the end of the show. So without further ado, I'm going to jump into key points of the week. Flip there real quick. Okay, so what are we seeing? Spot rates are plateauing a little bit. Maybe the better way to say it is they're losing a little bit of momentum. We're starting to see that sequential increase not be as strong, which could be indicative of a ceiling that we might be seeing. Total load posts down 21% week over week. Dean will show this in a bit. This is the typical lull we see. So very early October, which coincides right with the end of the third quarter. Things tend to spike and then trough out, and then we'll eventually start ramping up heading into Black Friday and the Christmas holiday. So truck posts increase 11%. That's just typical behavior, right? That's a sign of trucks posting the fact that they're there, typical capacity loosening, and pretty much all of the credible sources out there are showing August numbers rolling in that demand was flat or down year over year, and that's total demand, not kind of like a hyper-focused retail number that gets purported to be indicative of the entire market. But we're hearing capacities as tight as has ever been. A lot of that has to do with the dynamics between asset-based and non-asset, the broker activity versus shipper direct carrier activity, and we'll touch on that more later. But without further ado, I will turn it over to Dean.
Yeah, thanks, Ken. Breaking down some of those numbers a little bit further, if we start with the load-to-truck ratio on the dry van side, it's tracking really closely to 2017, as you can see from the chart there. There was a 23% decrease in the load-to-truck ratio last week, down to 4.26 loads per truck. That was driven by load post volumes, which dropped 15%. They're still 134% higher year over year, so that's significant. But available capacity eased slightly last week, with 12% more trucks looking for loads on our load boards. On the refrigerated side, very similar pattern. The load-to-truck ratio dropped 19% to 8.65. Reefer load posts also dropped about 10% last week, and about the same percentage of trucks posted looking for loads. So again, a little bit of a sign of capacity loosening in the refrigerated market. And similar trend with flatbed. The load-to-truck ratio followed the same downward trend, decreasing 14%. Outbound load posts on the flatbed side decreased 6%, and there was an 8% increase in truck posts. We'll break that down a little bit further at a market level when we get to our market condition index. So moving over to our dry van MCI for the week, we can still see how out of balance the market is. Ken mentioned the Michigan State University numbers. Their for-hire trucking ton-mile index shows that demand or volume is down about 3% year over year, but capacity, based on their capacity tightness index, it's as tight as it's ever been. In our top 10 freight markets, we see a little bit of this imbalance. Our top 10 freight markets in dry van account for about 23% of all of our load posts. In those top 10 markets, volume was down 14% week over week. And notably, our number one market typically for dry van, it's a big distribution hub in Memphis, ranked number one. Load post volumes dropped 2% last week. That's significant, but capacity is still tight in the Midwest. Rates are up 1 cent per mile to $2.99. And on the West Coast, we've been following a lot of the import volume from China in particular. In Los Angeles, our number 3 market, and Ontario, our number 5 market, load posts dropped 16 and 20% week over week, respectively. There's some pretty big drops in those large import markets on the West Coast. Over to the refrigerated market condition index, we see the transition that Ken alluded to in this lull season. We kind of transitioned from summer to fall seasonal produce volumes. Halloween's just 2 weeks ago. Pumpkins are literally carving it up in terms of volumes. 62% of production comes out of just 10 states, but the biggest producing state with about 40% of pumpkins is Illinois, and it's a whopping 12,500 loads approximately is going to come out of mostly out of the Rock Island market in the southwest corner. In that particular market on our MCI this week, volumes are up 34% in southern Illinois, and rates are up 3 cents a mile to $2.60. Nationally, pulling back a little bit further, our top 10 refrigerated markets account for 22% of our load posts. Volume in those top 10 markets was down 9% last week. Notably, our biggest market on the East Coast, our number 1 market, Elizabeth, New Jersey, volumes were down 15% week over week. And on the opposite coast in Los Angeles and Ontario, reefer volumes were down 7%. Fresno, another large produce market, down 22%. And as we mentioned last week, in the Midwest, particularly in Joplin, where a lot of poultry produce occurs this time of the year leading into Thanksgiving, capacity is tightening. Rates are up 9 cents to $2.57 a mile for refrigerated. Moving over to the flatbed market condition index, volumes dropped 16% week over week in our top 10 flatbed markets. They account for 27% of load posts. Our number 1 market typically is Memphis. Volumes in the flatbed side dropped 11% week over week. Decatur, volumes dropped 4%. In fact, Alabama is typically our largest state when we aggregate the markets. If we look at Decatur, Birmingham, and Montgomery, flatbed volumes were down 12% week over week. And another big market that we typically see a lot of flatbed volume is Little Rock. It's our number 3 market last week. It recorded a whopping 23% decrease in load post volume. Widening the aperture a little bit to our top 20 flatbed markets, The top 20 flatbed markets account for 44% of load post volume, but only one of the 20 markets, which was Detroit, recorded an increase. The other 19 recorded a decrease in volume last week. So wrapping up with our year-over-year view on dry van spot rates, last week we theorised that the increase in spot rates in the prior week was due to end of month, end of quarter. That seems to have held true as rates cooled off this week, stabilising around the 225 per mile mark. Dry van rates are still up 50% year over year and at the highest level seen in the last 5 years for the fall shipping season. And as Ken mentioned, some signs of reaching a ceiling there. Definitely a ceiling or plateauing occurring in the refrigerated market. Rates were pretty flat throughout most of September. They've stayed around the $2.40 a mile mark. They're still 34% higher year over year. And they're only 1 cent per mile shy of the record that we set in July 2018 when capacity was just as tight. Finally, on the flatbed side, flatbed spot rates were pretty flat last week, literally, and ended at about $2.24 a mile. Now, even though spot rates are now 42 cents a mile or 23% higher year over year, there are definite signs this market is cooling and they're reaching some sort of a resistance level as we move deeper into fall and closer to winter and temperatures start to cool off, impacting the building and construction industries. So that's this week's market update for supply and demand. Ned, over to you for the rate forecast.
You're not going to get away with that
real quick.
Yep.
I need to do a couple things here. First of all, we had a question come in about it was not on the broadcast, it was earlier this week, about intermodal volumes. Dean, are we seeing that? So the assertion was that we are starting to see a little bit of the capacity crunch soften for rail volume moving from west to east. Is that panning out in the truckload data?
Slightly, Ken. Volumes are down ever so slightly. So it looks like that peak in import volume that was driving a lot of the capacity tightness on the intermodal side, it's starting to abate. When I look at the last 4 weeks of load post volumes, they're definitely starting to decline. But capacity is still tight on the truckload side. So I think that theory is holding true.
All right, it'll be something to watch. So I'm actually going to do a twofer here because Bogdan asked how long are rates going to stay this high, and I also want to kind of point at the scoreboard. So I wanted to ask a producer to run the clip of what's it called, Ned? You do it a lot better.
Watch 2020.
Can we roll the clip?
If I can interest you folks in a wager, and that is a Price is Right style. Where do you think dry van rates will be before Halloween? And those that lose will be dressed up in appropriate Halloween-y costumes.
I'm in.
Yeah, I'm in.
All right.
I'm in.
Dean, do you want to go first?
I'm thinking by October 26th down to 210.
I'm going to shoot for 230 a mile.
Yeah, just for kind of symmetry, I think I'm probably going to go in at 220 a mile.
And remember, it's Price is Right rules. Closest without going over the actual rate.
And where do we stand?
Drum roll. Technical difficulties, please stand by.
It is like 7 o'clock on the West Coast.
All right.
Oh, geez.
So it looks like Ken is still in the lead, and the forecast is still shooting for right above Ken's number. But I have an objection. Dean, you're the one who made this graphic, and you put my star 5 cents too high. There's no need to sandbag things.
Way to go, Dean.
I was happy no one had noticed that.
Go ahead, Ted. Sorry.
I was going to say, these next few weeks are crucial, right? I mean, I just wanted to level set too. The last week captured in our data, right? Just because we run in like trailing weeks when we do this show. I want to actually ask the question, not state it as a fact. Ask the question to Dean. The last week on record prior to this week would have been the end of month, end of quarter, correct?
Correct.
So a lot of these sequential declines we're seeing are coming off kind of the periodicity that would indicate that week would have been big no matter what, and then this week would have been slow, kind of absent anything else.
Sorry, my camera fell off. I wasn't trying to avoid the question.
Yeah, with all the Supreme Court hearings going on today, I was going to say everyone's in the mood of dirty.
Oh, geez. All right.
Okay.
All right. So the answer was yes.
Correct.
Okay.
And we're seeing a lot of that. But prior to that, though, Ken, I'd noticed a lot of those volumes were starting to decline week over week anyway, even though there was that blip at the end of October.
Can I actually interject here, because we have a question from the audience. Derek asks, do volumes down equals less demand for the equipment or more demand for equipment? And I think that this is a good time to answer that. Volumes down means that there is less equipment running around. I
think let's just level set. When DAT talks about supply and demand, when we say demand, we're talking about loads. When we say supply, we're talking about trucks.
Mm-hmm.
And I understand that that's a little funky if you're a carrier, right? Because to you, the supply is the loads, and you're competing against demand for capacity. But when we talk about demand, we say loads. When we talk about supply, we say capacity. Just to level set. That's a great question, though. So when we say volumes down, there's less demand for trucks, which is why you're seeing them post their truck available, whereas probably the past few weeks they were searching for loads to not have their phones blow up every time they posted their truck available. Hopefully that answers the question. So, Ned, you want to walk us through, because there is actually a fourth horse in this race, which is our scientific model that you developed.
Yes, Raycast. I mean, I think it's going to be interesting. So this is our dry van forecast. So the blue line here indicates the actual market rates observed by DAT. And then off to the right, you can see our forecast models. We've got 4 different ones. The green is the Ratecast model, which is our flagship model. The red is our short-term model, which has been doing pretty well during the course of the pandemic. And then in between, we have our 2 blended models that are mixtures of the Ratecast and the short term in different ways and in different proportions. And here you can see that there's a lot of model divergence, where Ratecast is really expecting there to be a plateauing that you guys were expecting or talking to, whereas the short term has been expecting kind of continued up and to the right. And I think it's going to be interesting to see how things go forward. Next, I'm going to be talking to our reefer spot rates with that same effectively chart, where again, the blue line is the actual market rates observed by DAT, and then off to the right, we have those same 4 models that are trained on reefer data. Here you can see that there's a lot more model agreement. There's a little bit of disagreement about kind of the initial level, but and going in through kind of the critical period of the bet, unfortunately. But once we get back to November, all the models are coming back into harmony, which I think is kind of an interesting feature. And then finally, we are going to move to the flatbed rates. So again, the blue line is the actual market rates observed by DAT. And then off to the right, you can see our incredibly divergent set of models. Here, Ratecast is pointing down and to the right, and the short-term model is expecting a continued up and to the right. From what we've been seeing, that there's a little bit of softening capacity. I expect Ratecast or the blended forecast to be more accurate, but I've learned not to bet against the short-term forecast recently in very personal ways. Does that cover the forecasts well enough, Ken?
Yeah, I'd like to put a question out to our audience, either today, if you're watching live, or if you're watching it recorded. We've heard a lot, right? It's RFP season. Every single call I've been on the past 2 weeks has started off with, I'm knee deep in RFPs, whether I'm a broker, carrier, or a shipper. I'm just curious if our audience would like to see maybe the 52-week view of Ratecast, because that'll really pull in what 2021 is going to look like. So if there's demand for that, I think that's something we can probably whip up, right, guys? I don't want to. It's not me doing the work, so I don't want to volunteer.
No,
you guys.
I mean, I'm making the forecast anyway. It's just a matter of making them tidy. I will say, though, the short-term view is not going to be reasonable going into the 52 weeks. So we might just show the Ratecast model.
Oh yeah, for sure. I don't. Yeah. Well, that's kind of defeats the purpose, right? We show these other views in the short term because there's so much, right? Time kind of the long arc of time blends out some of these, like almost anachronistic things we're seeing, right? These kind of major decoupling from seasonalities. Yes. So yeah, if anyone listening or watching or anyone over the next week has interest in that, let us know, and that's something we can definitely whip up for next week.
Yeah, I would say to kind of put a finer point on it, the supply and demand in the week second week of October of 2020 is not going to have a big impact on what the actual rates are going to be in, let's say, March of 2021. So the short-term model, which relies more on the supply and demand indication, is, not going to have as much information there.
Which is, I think that in and of itself, Ned, is like an important thing for folks responding to RFPs to think about. Is like, don't lose your mind because you've had a rough week, right? Let's just say that your budgeted PT is 85 and you had a rough week and you may have came in at 89 and your director's barking at you. Stay the course, rely on the data, focus on what you know. The fundamentals are going to hold true for 21 when you do these long-term planning. So trust in the data that's got dance with who you brought to the dance.
Yes.
Keep responding to these RFPs, using the data, using the science, and understand that this too shall pass, I guess. Yeah, it's already seeming like we have a ton of demand for that. So I think that's just something we can kind of decide that we're going to do.
Not a problem. I'll add it to the set of forecasts that I generate for you folks.
So given how well you did with your Seinfeld impression last week, Ned, do you want to read us the Ask IQ question for the week?
I do. Hold on one moment while I pull it up, and then I try and do it a little bit more. What's the deal with peak season shipping? I mean, is it season? Is it shipping? Come on.
I think Dean's probably the best equipped to tee this up because he's watching the market so closely.
Yeah, I think because we've got Amazon, Target, Walmart having their pre-Christmas sales this week and pulling forward a lot of that online shopping activity to try and flatten out the peak season shipping that typically happens with a lot of in-store shopping closer to Christmas. I think there's a resistance for people to go out and shop in big department stores. In fact, some of those big stores are closed on Thanksgiving. So we're seeing a lot more Black Friday sales now. But if you work back from that, for that to have happened, for that inventory to be in warehouses before this week, a lot of that had to have moved sometime in the last 8 weeks from overseas. So I think a lot of that peak shipping volume that we typically see, in later October, early November, getting ready for retail season is actually already in warehouses now. That said, we still could see some more pulling forward of warehouse inventories leading right through to January. I think retailers will be reticent to experience another inventory failure season like they had this spring. So next spring's volume could continue to be pulled forward all the way through to Chinese New Year at the start of February.
Yeah, I mean, I think if you worked at like a FedEx or a UPS or a DHL through 17, that peak, whenever we had kind of leading, teeing up 18, which was ELDs coming, Harvey, Irma, all that kind of stuff that led up to the culmination of fall of 2017. I think service is going to be very much front of mind. I know that those companies were very aggressive in locking in their external capacity to supplement their assets heading into retail. I also think too, just knowing how these companies, especially like Amazon, like to run tests, right? Not just on their website, but kind of in real life. I think Prime Day will be a real interesting test because they could leverage their air networks to get more inventory in for a strong Black Friday. But conversely, if Prime Day is a bit lackluster and we're really starting to see some of the toll of that increased credit card debt and declining customer spending, they might be a little more bearish and choose to go leaner through the kind of more traditional Black Friday shipping season.
So to kind of synthesize this, what you guys are saying is there is a possibility that peak season is in the rearview mirror, or at least like we're driving through the bumps.
Certainly flat.
Yeah,
I mean, this could be so typically it's an M, right? So end of month, end of quarter, obviously the end of September. That happens every year, right? Unless they're going to change the Julian or the Gregorian calendar.
Julian. I don't know.
So it's an M, right? So it'll peak out there. You'll see this lull where everyone's kind of getting ready and licking their wounds. And then it kind of like runs off like a bear into the terrible reference. It runs off like crazy into Thanksgiving and Christmas. I really think you're still going to see that. I mean, people are still going to go out for Black Friday. Even if stores are closed on Thanksgiving, people are going to be after their turkey. They're going to be shopping on Amazon and Walmart and Target and Best Buy. So, I mean, there's still. I don't want to paint the picture that it's going to be a coast out through the end of the year. I do think things are going to get really, really tight between Black Friday and Christmas.
The other wild card on the other side of this is the manufacturing side. Ken, anecdotally, a small data set, but I went to order some glass this morning for some broken windows that we've got to replace here, and they said the earliest we can get to see you is 4 weeks away to do the measurement, and then after the measurement, it's another 4 weeks before we can have the glass delivered. And the company that does the glass said normally we get 4 deliveries a week, we're down to 2. And the manufacturers literally can't produce enough glass to meet demand because of the impact of COVID. So I think on the manufacturing side, there's real issues with, just producing the volumes of freight that we typically see on the industrial side.
I think that's interesting. That's interesting. I think that to kind of tie into that, we got less a question and more a comment from Alan. If I can pull it up properly. Sorry. That they're experiencing record demand and also having a hard time keeping driver count. So I think that the combination, I think it's going to be interesting to see the combination of the difficulty in retaining and keeping drivers combined with reduced industrial production, or rather the inability of industrial production to keep up with demand, and how that's going to impact rates and the kind of shipping cycle. Yeah.
Well,
so maybe we'll answer this one last question from David. Do you want to hit us with that one, Ned, and then wrap for the week?
Sounds good to me. We are running a little long. Sorry. David says, I'd like to see the 52-week forecast view. Can you forecast contracts? The answer is yes, but we do have a contract forecast that I do run. The thing that I would say is the contract forecast typically is less exciting to show on TV because it's flatter, but I'm more than happy to throw that up if you guys are willing to sit through a line that moves a little bit.
Let me level set real quick, and the reason I like this question, so thank you, David. I would say 90% of the time when folks ask us about a contract forecast, they're actually asking us for the spot forecast, and here's why. So let's just think of the overwhelming majority of transactions that involve a contract in the broker space are contract on the sell side. So I'm a broker and I have a contractual relationship with my shipper, but then I'm mostly covering that on the spot market. Now, as I become familiar with that shipper, I may become more inclined to lock in certain lanes or dedicated or routes with my capacity. So if you're a broker, most of the time what you want is the forecast for the spot market, so you can make a much more intelligent decision on how to lock in price with your shipper. We do, as Ned said, have a contract forecast, and that's really helpful if you're a shipper trying to kind of forecast spend, perhaps, but you're already familiar with the fact that that doesn't move very much if you're in that position. And then if you're a carrier, especially a large carrier, trying to understand, let's say your mix is 50-50, spot and contract, you can use that to fill in the holes where the spot forecast doesn't line up, I guess.
To give kind of a fun anecdote about this, one of the challenges that we had when we were working on RateCast is disambiguating what I would call like semi-contract freight from true spot freight. So semi-contract freight is something where you have like a repeated relationship with the same carrier, and so you're charging them the same amount over and over, and it looks in a lot of ways kind of like a mislabeled contract rate, where you'll have like a relationship with them where it's like, you want to do it for the same amount? Yeah. And so trying to disambiguate those numbers, I found was kind of interesting. And the answer is that we decided not to.
Yeah, we're actually talking about that now, though, right? It's like it may be like a more of a recurring rate.
Right.
Right, because we've called, right? We have the data. We call up a broker and say, hey, this really looks like a contract rate. And they're like, no, that's Windy City Carriers out of Chicago, and we have a mutual understanding that we moved that for $1,200. There's no contract. Mm-hmm. Sorry, Windy City, if you're listening. That's a familiar carrier name I have at the tip of my tongue. We have one more question from Willie.
Yes.
And then we'll wrap. So I lied earlier. Sorry. What about the transportation industry in Michigan? And it's his first time on the show, so thank you for joining us, Willie. Again, I'll turn it to the market expert, Dean.
Yeah, interesting, Ken. We've seen a lot of activity in that particular market. The Saginaw market's had some increased volume this week. Grand Rapids market volumes are down, though. But in the bigger market in Detroit volumes are down about 25% month over month on the load post side. So there's definitely a slide in volumes there. They've been trailing off since September 19. So I'm not sure what's going on there. We did see a lot of inbound market from the Pacific Northwest a few weeks ago on the dry van side. I suspect some of that was imports that came in from Asia via Seattle. So we were able to verify that through some of our brokers. But it looks like the market has cooled right down now, with the exception of Saginaw, which is a much smaller market. But the bigger market of Detroit, volumes are down significantly and trailing right off.
Yeah, anecdotally, that's about all I can offer here. Just talking to some friends from the industry, the auto industry is still very slow. Kind of that tier one auto supplier and the big three themselves in the Great Lakes area are just still quite slow.
I mean, capacity is still a bit tighter, Ken. I mean, it's the same effect across most markets. These markets are, there's still upward pressure on spot rates in all three markets in Michigan, which is sort of symbolic of every other market. Rates are about $2.40, $2.54 a mile right now out of that market. So there's still upward pressure on spot rates.
All right, cool. All right, so with that, I'm going to call time on today. I do have a few wrap-up items, so thank you everyone for joining. A lot of really great questions. If you want to keep the conversation going in the comment section, I'm sure our marketing team, they're diligent about making sure that you guys have the answers that you need. If it's a more complicated or technical question, feel free to shoot us an email at askiq@dat.com. We also have Dean's outstanding long-form report at dat.com/market-update. And I know we talked a lot about forecast this week, and I hope I'm not speaking out of turn, but if you have an RFP on your desk and you're kind of stumped or you're overwhelmed and you want to maybe a little free sample, if you will, of RateCast, feel free to shoot us an email at askiq@dat.com. I'm pretty sure that's something I can make happen. But with that, like and subscribe, please. It's the best way to get notified of our content and anything else that we put out there. And with that, we will see you next week. And I hope everyone has a great week. Bye.
Bye all.
Bye-bye.